Welcome back to my InvestEngine portfolio update now for the month of October. I've missed a couple of months as I've been moving house, trying to get everything sorted. Lots of things took a bit of a backseat. And of course, I had to paint all this room, etc. But anyway, we're back in. It will give us a good chance to actually see what's been happening over the past few months in the stock market because, as I've spoken about on some other videos on my channel, there's been a huge amount going on as per usual. And there's always drama happening around the world. Just very quickly on some of the stock markets, you can see if you zoom out over the past 6 months, for example, and we have a look at the likes of the S&P 500. It's probably one of the smoothest graphs, which just moves up and up and up. And while there have been a few pullbacks and very small blips, very much has been straight up to the top right. So anyone investing during this period should be seeing green in their accounts. Obviously, there's a little bit more detail than that. Anything we see at the moment from the S&P 500, bear in mind this is done on a dollar basis. There has been a lot going on with the exchange rate and the way the pound interacts with the dollar. As the pound gets stronger, you effectively are able to buy more of your investments, which are denominated in dollars, which are all those big tech stocks over in the US. However, a strong pound, unfortunately, does mean any investments you've already bought in your accounts can appear weaker. So during certain time periods, you will notice in your account that it's not keeping track with the S&P 500. It might look a bit differently. And all of this has been down to the exchange rate. It sometimes works out well. If you have a look on screen now, you can see at least over the past month, anything denominated in pounds, which would be this yellow line here, has actually gone up more than the S&P 500 itself, which is quite interesting when you look at it from a pound versus dollar perspective. Now, what's been interesting over the past few months is that not just the stock market has been hitting new all-time highs. When you look at the S&P 500, even the FTSE 100 here in the UK, and even other places in the world like emerging markets and the rest of Europe, you've also seen other asset prices increase wildly too. So many of you will be familiar with the likes of gold and now silver hitting all new time highs too. Gold, in fact, has had a really good run over the past 12 months and the past few years. In fact, I did see an article recently saying gold has outperformed even Berkshire Hathaway, even beating old Warren Buffett over quite a long period of time, actually, which is very interesting. And actually, it's a weird kind of time that we're in at the moment where assets like gold, which typically are a kind of flight of safety, meaning that people tend to go there when they're worried about their money being deflated away and maybe even worried about asset prices, are also investing in gold at the moment. Cryptocurrency likewise too, although there's been a bit of a pullback in terms of the price of Bitcoin. You have seen Bitcoin hitting new all-time highs. I think the new all-time high hit was around $125,000 per coin. So we're in a weird place at the moment where almost everything is at all-time highs, which is of course giving people a lot of feeling at the moment that we are in some kind of bubble, some kind of everything bubble, almost similarly to what we had back in 2021. Now, if you want to go into a bit more detail on this, I have made a video on the topic about whether the stock market is overvalued. I think it's a question you can ask every single day forever. And I do think it's a bit of a dangerous kind of thing to get lost into. I think a lot of people get very much worried about asking this question before they start investing when really they should just start investing. 6 months ago, we could have had the exact conversation. And I'm sure lots of people have held money on the sidelines waiting for that perfect right time to invest. But let me give you a bit of a clue and a bit of a thing. In my opinion, there is never an amazing time to invest. The best time to invest is always now, today, if you are a long-term investor. Now, one more thing I wanted to point out just before we go into the portfolio itself was something that I quite like to keep a bit of an eye on. Now, because all assets have increased in price, it's a reminder. I saw an article about this the other day that there's just so much liquidity. There's so much cash in the system, basically sloshing around. There's even an enormous amount of money sat on the sidelines effectively from both retail investors and institutions in money market funds. So money market funds are actually very short-term debt, short-term bonds, which you can buy. Basically, the safest place you can put your money in effect. It's like a guaranteed increase, a guaranteed rate of return. And if you have a look at the stats from the US, at least, because they're published weekly, I believe, we're over $7.3 trillion worth of cash sat in money market funds. So this isn't billions or a few hundred billion or anything like that. This is trillions of dollars, which is an extraordinary amount of money. Now, as you can see, at the moment, retail are holding nearly 3 trillion and institutions are 4.3. Now, not all of that money will necessarily want to flood into the stock market, but I did just want to highlight there's still this extraordinary amount of money sat out there, which could, in effect, be moved into assets, moved into the stocks, the stock market, I should say, at any point. Just a very interesting thing to point out. We don't get this exact level of detail in the UK, but I did read something saying that people were actually moving money into money market funds out of the market, even during a time where the market was going up. However, this might be because people were worried about potential changes happening in the budget. So I wouldn't necessarily look too much into this from a UK standpoint, at least. So let me just log into my InvestEngine portfolio now. I'm actually going to use the web version, which basically looks exactly the same as your app anyway, just giving me a bit more freedom to have a look at. Now, over the last few months, it won't surprise many regular viewers to know that I have done exactly the same with all my investments. So I regularly invest into my stocks and shares ISA using InvestEngine every single month without fail. And I'm going to continue to do that as we move into the new financial year and the new calendar year as well, which is just very close and coming up against us very quickly. I do also have a second account with InvestEngine too. So you can see if I scroll down, I do actually have a small SIP. I just wanted to really test out the platform and see what it's like. I'm not putting any more money into it at the moment, but I did this for a few months just to really see what it was like. It's an interesting thing that I wanted to see how things work and how quickly the money was topped up from the government. So you can see that one's in there now. But for the time being, I'm going to go into my portfolio and just see how different things have been going. As you can see, overall value at the moment, if I click into it, is at £63,422.78. And we can see here all the times that I've put money in. If I just go net contributions here, you can see the blue is basically all the time I've put money into the account. And the green is the total value right now. If you're a regular viewer, you know that I'm slightly complicate things, don't just have a single index fund. What I've done really is taken the globe, taken the world and all the markets that are in the world and basically split them up. And I've done this to reduce my costs. So all of these 5 different Vanguard index funds basically represent the world. It's not a perfect representation of the world. There are small parts that are missed out, and there are slightly not perfect percentages, but I'm not looking to create anything from perfection. I did want to have a little bit of a play and almost use the platform to show off what was possible. And also what's really interesting from a fee perspective, as you'll see here in the top right, is overall my total expense ratio is just 0.08%, which is extraordinarily cheap when you consider what people used to pay many years ago. And actually, one thing worth saying as well, this portfolio expense ratio did used to be 0.09%. However, you may have seen the news recently that Vanguard actually reduced fees on some of their ETFs, of which a couple of these, from the top of my head, have been reduced. I'm almost certain Japan has. I'm not sure which other ones got moved as well, but I'll put that up on screen now to show you which ones they actually reduced the costs of. And some of them they reduced quite significantly, maybe because they were feeling the pressure from some other competitors out there who do have some lower cost funds, and people, quite rightly, were chasing those because ultimately the lower cost you can have your investing, the better when it comes to future returns, because any fees you pay now are guaranteed losses effectively. It's money that won't grow forever in the future. Now, here's something interesting I wanted to go through. As I look back over the max performance, this is all great, and you can look at basically everything's in the green. Some things have done better than others. And in total, of course, the US stock market has just outperformed everything, and it makes up the biggest percentage in my account here, up 57%. But other markets have done actually not too bad in the end. Japan has lagged behind if we look at it from a maximum perspective. However, let me just show you over the past 6 months, for example. It's 3 months worth of updates, couple of months worth of updates, which I didn't show you. What's actually happened here, if you have a look at these percentages, is actually the rest of the world has performed relatively well. Yes, the S&P 500 has done extraordinarily well, here up over 26%. However, emerging markets have had a really, really good time at 25%, Japan 20%, and even the FTSE 100 up over 15%. This is an important lesson that I always keep coming back to, just showing how important it is, at least in my opinion, when it comes to diversification, that there is a bigger market out there than just the US. And when you are investing into the US, you are exposing yourself quite a lot to that exchange rate. Remember I spoke about earlier between the pound and the dollar. So it's really, really interesting to look at how over the short term and longer term, different markets perform. And remember, in the future, we have absolutely no idea how different markets are going to perform. So in my view, at least, I think it's really important to make sure you well diversify. This doesn't mean that I think the S&P 500 is a bad investment or, for long-term investors, nothing like that at all. I just prefer to make sure that I capture all of that global market, because there is a chance that over the next 10 years, the next 20 years, for example, and whatever your investing time horizon, that you may get a little bit more performance and have some slight less risk if you invest globally rather than the S&P 500. basically we don't have any idea, which is why I come back to this position where, because I have no idea what's going to happen in the future and no one else does as well, I just prefer to own everything. It really goes back to the philosophy of being this passive global investor. Basically, you own everything. And this is also highlighted if I just use a much shorter time period, just over the last month, for example. You can see here that almost every market, although they've been very similar really, has performed as well, if not better, than the S&P 500. So it's really important to remember that there's a bigger world out there and why it's so important to stay well diversified. But now, of course, that's my opinion. I'm not a financial advisor. I just show what I invest here on YouTube. As always, love to get your opinion on what you do in the comment section below. At the moment, there is quite a lot of talk around putting things like crypto now inside of your stocks and shares, ISA and pensions. I've done a couple of videos on this now because these are now possible on certain platforms. It will really going to depend on the platform you use. And lots of people, of course, like to add in different things like gold and silver to their portfolio. Again, it's all completely up to you. Whatever you want, whatever you do, make sure it's right for you. Okay, the final thing I'll leave you with this month is just to say at some point, I will have to rebalance this portfolio. Maybe I'll do it as we head into 2026. I really don't want to complicate things too much. I'll have to rebalance it maybe once or twice a year. I do get some interesting comments asking me how often you should rebalance your portfolio. I think the answer there really is to do it as less frequent as possible because, of course, there is the opportunity there when you are buying and selling investments. There is that small price difference between the bid and the ask, effectively the spread. If you were doing it very often, there is a chance to lose some money there. And it does put you out of the market for a very short period of time. So remember, with these things, you're just trying to match whatever your own investing goals are. For me, I like to match the market pretty closely, but I'm not going to try and do it month by month, for example, although it is very easy to do on a platform like InvestEngine. Anyway, I hope you found that update useful. I will see you in the next video. As always, happy investing.